Good morning, David. I know it's early for you too. You're on the West Coast?
On the left coast.
Left Coast, yeah. I used to say my life is like a farmer, up before sunrise, asleep after sundown, except that I nurture seeds of greed for the harvest of commissions.
Okay.
Anyway, so that was Farmer Dale, and you know how to share, right, David? Do you have anything you want to show, or do you want me to put
Yes.
Twitter up?
No, I would like to share. Let me just see if I can.
There's a green button.
Yeah.
Yeah, I got to pull up the screen first.
Yeah. In the drop-down menu.
There we go.
Have you ever nurtured seeds of greed for the harvest of commissions, David?
Come
on, admit it.
Yes, absolutely. Yeah.
Okay. Okay. We have a confession.
Guilty as charged.
Yeah. We're only human, you know. I mean, we have to make money. So, okay, David. Thanks so much for stepping up and coming in today. And, you know, there's a lot of chatter about the repo market, some type of year-end squeeze. You going to address that?
Yeah, and then also a little bit about what we're seeing in the metals markets as well, if we can.
Sure.
Maybe as a side note to start, I'm calling in from Vancouver, Canada, and I was looking at Canada's balance sheet on the weekend. This might sound like a little bit of a divergence where we're going, but it all goes in kind of the same direction. But I looked at Canada's national balance sheet, which is put out by Statistics Canada. And to give you a sense of, it's not just the US that's credit dependent, but Canada. In the last 12 months, Canada's total outstanding debt, and that's federal, provincial, corporate, consumer, you know, the whole ball of wax, municipal, etc., increased by $734 billion. And to give you a sense in Canadian dollars, that's about a $2.3 trillion economy. So you're talking about a 31% increase in outstanding credit in 1 year, $734 billion in a $2.3 trillion economy.
Housing related?
A lot of it is corporate. Some of it is housing, for sure.
Okay. But because we know there's like prices are pretty extreme.
Yeah.
Right. So
the oil producers here in the tar sands are in difficulty, and they're borrowing as much as they can, as often as they can, to keep their noses. But everything, Dale, in these credit cycles, what happens is it goes faster and faster until it stops. And historically, that's what happened with Weimar. And I think that's what I'm seeing here in Canada and in the US as well. And that's why it's so critical, not to cut off the credit suddenly. You've got to restructure it. But so the comments, I posted it on Twitter, and the comments were Canada's credit rating is AAA. What are you talking about? And, that's just the federal debt is AAA. But when you look at these things, people say, well, our credit rating is good. And, how could there possibly be anything wrong? I always like to pop this chart up.
Yeah.
And this was the Enron chart.
Yeah.
And you can see here.
A little late on the downgrade.
They were.
They couldn't upgrade it from there. So bankrupt. Let me ask you this, David. I'm really not sure. Does bankruptcy affect your credit rating? It actually cleans it up, doesn't it? Cleans it up.
Eventually it does, but initially it takes away your access to credit for a period of time.
You mean I can't go to Union Bank today and go, listen, I'm broke. Yeah. I'm in debt. I'd like a personal loan. I want to take a vacation to Hawaii.
Right. You got 100 million.
It's not going to happen. Yeah. So you have to be deeper into the bank. It's better to be deeper in debt at times, isn't it?
Well, that
was a bank to work with you.
That was President Trump's statement to the bankers, right? If I owe you 100 million and I can't pay it. Sorry, no. If I owe you $100 and I can't pay it, I got a problem. If I owe you 100 million and I can't pay it, you've got a problem, right? And
he's the king of debt. Yeah. He said that. So
and this is that last curve reminded me of this one. which is 1,000 days in the life of a turkey. Everything looks good until the last day here.
Gosh, poor
Right.
turkey.
That's
Yeah.
that's criticality theory, and it's a bit of a joke, but it is what applies in natural systems. In non-digital systems, criticality theory is the failures come very quickly and they come suddenly.
Yeah, it's like, for a while, some issue may
That's
not
right.
matter. It doesn't matter. It doesn't matter.
Right.
Like maybe impeachment. It doesn't matter. And then all
Right.
of a sudden there's a tipping point.
That's right.
And then what didn't matter matters dramatically
all of a sudden, and it's the
Yeah.
most important thing in the world.
Yeah.
So maybe just a quick recap here. Sorry, my slides got out of order a little bit, by the way. I don't know why they popped up to this mode, but let's just close that one. Poor turkey. So just a quick recap here about this. In a credit bubble economy, the critical thing is that you maintain the flows of your money supply. So the blue line is your annual rate of change, and this is 0%. It's probably too small for you to read, and there's 18%.
Right.
So there was the reflation after the dot-com. This is the twin horns of reflation after the GFC, Great Financial Crisis, and I'm maintaining that we're heading into another one now because they've cut off the money supply. And the reason the money supply is so important is, let's go.
Did the Fed exacerbate it by not doing anything at this last meeting? I mean, I know there's a big lag, but I mean, if they can see the same charts you are, why would they pause if we're already heading into something that they caused through QT?
If you read Powell's speeches, I think that he really fervently believed what he did personally. But I call him Lee Harvey Powell, because for me, he's just the guy that arrives at the scene that gets to hold the bag at the end.
Okay.
I don't think that he fully understood he comprehended what he was doing. I think the Fed was headed. I mean, it was Yellen that started the cuts, and the cuts were almost done by the time that he came in. I mean, he came in the middle of 2017, right? So
you mean the QT? Yeah, the QT Yellen started.
This is where Powell showed up right here, right?
Okay.
In the middle of 2017.
Right.
So sorry, right here. That's where he showed up.
And he didn't stop until a year ago.
Yeah.
He stopped it a year ago when Yellen and Bernanke and him were singing Kumbaya together.
Well, the markets had a fit in December of last year at the year end, right? So, and the reason it's important that you can't cut the money supply is this ratio here. Here's your repo market, 5 trillion. Here's your 14 trillion of cash in the system. Here's your 72 trillion of debt that it has to service. So there's your 5-to-1 ratio. So just a quick recap here, right? And this is, of course, the derivatives, 200 trillion. But it's this ratio here that means that if you cut the money supply, that you're going to have real problems, because you've got the leveraged effect of the lack of liquid currency to service this debt. Not to increase it to keep the bubble going, but just to service the interest on it, which is compounding. And sorry, what happened? Yeah, so what happens when you cut the money supply? Let me just jump here to this one here. So you can see here, this is the Small Business Confidence Index. There's no title on it, but it's from a website called paychex.com. And Paychex is a payment services company. So paychex.com.
Okay.
There's 100. So this is a small business confidence index. And this is 2017. You can see that they've gone under 100 on the index, and the rapid decline here. And look what happened back in 2007, 2008. So, these small businesses are the ones that create the majority of the jobs, right? It's not the large cap companies, and that washes. I think I've got this chart up twice here. Sorry, just let me close one. So this washes through, the constriction of credit washes through into the economy, and the first ones to see it are the CEOs, and we can see that from the charts here. The orange, CEO confidence, and the purple is the consumer confidence.
Yeah,
and look,
Opposite extremes.
Opposite extremes. So this goes back to July of this year, but you can see where we are in terms of the confidence of the CEOs. And you can see where we are. They keep talking about, the consumer is strong. The consumer, as the Michigan survey, looks really good right now. Things are great.
Do you think it's just because of the news flow of stock markets going to new all-time highs, even though a lot of consumers don't even own equity? They just think everything's okay because the stock market is going up.
Yeah, and I think it goes. I think it goes as crazy as it sounds. I think it goes back to that Turkey index. Things are the very best just before they turn down because of your lack of perception.
Okay.
Right. Things look, or the Enron chart, right? You're really not seeing it until in the last very, very short period. And that's what you mentioned. Who was it that said that, they went bankrupt gradually and then suddenly, right?
Yeah.
That was the old statement. Like, how did you enter bankruptcy? And that was the response was, I went gradually and then all of a sudden, suddenly.
Right.
So
when do you think we're going to have some suddenly happening in some of these financial markets with the backdrop that you've described?
Well, quite soon. Let me just buzz quickly through a couple more charts.
Sure, go ahead.
So this goes to your question about why aren't the market, referring to the markets and how the markets are behaving and the perception of confidence. This is a ratio of tangible book value, and this is Warren Buffett's alleged favorite stock indicator of the value of a company. And so a tangible book value, it knocks out goodwill. And what it does is it gives you a sense of what a company is worth if the cash stops flowing, if it's got a cash flow hiccup. And you can see back here, 1980, it was sub 1%.
That was the bull market. August of 82 was the launch.
Yeah. Oh yeah, the launch of the bull. Yes. Yeah. This was the. Yeah. What was the Time magazine cover? The death of equities was, right. I think, 1980, 81, right?
Right.
So you can see you're sub 1%, and now we're up at 11 times. Everybody's saying digital now and intellectual property and everything else, but the bottom line here is that we are trading at these extremes, and what we've seen through this entire period is the increase in credit outstanding to the point now where, the U.S. has $73 trillion of total credit, right? Total debt in the system, federal, state, corporate, consumer, municipal, etc.
Okay.
So
we should be looking for a gray shaded area here pretty soon.
Yeah. So this next slide here is where I transition into the discussion of the credit markets and what Zoltan Pozsar has been telling us. Are you familiar with Zoltan Pozsar, or Steve?
I've been hearing his name for the past few weeks, but before that, no. So I would say no.
Yeah. You and I mentioned him in the last interview that we did in the middle of November. It's about exactly a month ago. So Zoltan Pozsar comes from the Federal Reserve itself, and he's now at Credit Suisse, as you can see here. And he puts out this global money notes paper. It's free. You can go and download it yourself. This is the December 9th one that he put out. And he is regarded, he's been interviewed so well on Bloomberg and others, but he's very articulate and gives you a tremendously distilled view into what's going on in the markets. But I just want to scroll down to something that he talked about here. And he's talking here about the whole concept that we're seeing here and the issues that we're seeing with the year end coming and the tightness of the credit, is that he points out that the globally systemically important banks, they are now under the Basel III rules, and Basel III requires much higher reserves to be held. And what's happening here is we've got the year end, we've got the turn from 2019 into 2020. and they're having to jack up their reserves to meet the Basel III requirements. And what he's talking about here is the fact of the need for these reserves and to keep the financial system going. And I found this was such a clear statement of his here. He says, if carry makes the world go round and reserves make carry possible, the day we run out of reserves would be the day that the world would stop spinning. And no, this is not an overstatement. And so what he's referring to here is the necessity for the liquidity of the system to be continually available into the market. And if you run out of your reserves, you can no longer have the liquidity supplied. And what we've seen now with, and he mentions in the paper, I won't jump into the detail of it, but he mentions here that JP Morgan was so important in terms of being one of the very few banks, and he calls them the lender of second last resort.
Okay.
Right. So, I mean,
the Fed, then JP Morgan's on deck.
And a couple of others, right? And that they've gone away, and now, you know, and JP Morgan actually sold $130 billion, or took $130 billion of the reserves, pardon me, and then invested them in securities for reasons that I don't understand, but they no longer have the liquidity. And he says this is the first time that we've come into the turn, into the year end, with insufficient liquidity in the system before the turn. Even last year when the markets, you know, they had a tantrum last year, as you probably well recall, for sure well recall. And that this is a situation now which is worse than we have. And I just want to point out one thing that he says here.
One of our attendees, Brock, says that the SKU index has turned up sharply. Maybe inability to lower due to repo crisis.
Yeah. Yes. There's a lack of liquidity in the system, and it's very real, and it's going to get worse coming into the year end here. We're not seeing it yet. It happens.
He's also saying Deutsche Bank counterparty risk could be big influence, i.e. repo.
Yeah, I think there are many banks now, and maybe just point out this point right here. Let's see if I can get it to highlight. But so what Poser says in summary, year-end balance sheet constraints, there's a typo there, will preclude primary dealers from bidding for reserves from the Fed through the repo facility or through repos from money funds. So we see the Fed is intervening. I mean, they've got the not QE, the $60 billion a month that they're buying treasuries from the market. But the other intervention they have in the market now, the other primary one that they have in the market right now, is the repo facility. And what he's saying here is that because of the constraints on their balance sheets, you know, the repo facility is a debt facility. And so banks cannot access reserves by taking on more debt. Right? They don't have the balance sheet to reach into the repo facility to get the liquidity that they need.
Interesting.
So
they're basically they're in this process right now where they're going bankrupt slowly, and then all of a sudden,
the year end, it's turkey time.
Okay. All right. So when do you figure, like, the last couple of days of the year?
It's kind of like it's a curve that goes exponential, right? So there's a toe of the curve that we're in right now, and it gradually increases. But I think what was important was in that paper of his, that monetary notes number 26. I think it's essential reading for anybody that's in the markets. But what he says is that the banks have insufficient reserves going into the year end for the first time ever. And he says because of Basel III, they can no longer use the facilities that they had in the past to generate the required liquidity. So here's the Federal Reserve's balance sheet. So this was the taper.
Yeah.
In terms of the QT.
Right.
and
We're
end
above
of
we're above from where they started
right,
already in a
right,
short period of time.
yeah. So that's your 60
That's
billion a
like an
month.
emergency.
Yes, yes. Their actions, they betray their statements, right? They're behaving in a way which indicates that they now realize that there's an emergency in that. But this is, see, one other point here, Dale. This is this is in the markets, right? This is not the economy as a whole. And my point is that the whole emergency is being generated by a taking away of liquidity in general, or a major component of it is being generated by the taking away of liquidity by tightening the money supply. And it went on for 2.5 years before they started to loosen again.
Right.
But if we go back to the original chart, you can see, you can see here that, I mean, this is 2001. They loosened into this. This is 2007 in October. And I mean, this is where the crisis occurred. They loosened all the way into these market meltdowns. But your lag is a couple of years with monetary policy. So even if we start to loosen right now,
which they are,
okay, you're not going to be able to solve the problems, right? No.
Yeah, we have to pay the piper for QT, and that hasn't happened yet.
Well, and that's the nub of Posar's of his paper, is that repo, they can't access the liquidity through the repo market. The banks can't, and the only way that he can see it is one of two ways: is Canadian banks lending enough into the system for the turn, or the Fed restarting QE again with a QE4. I think QE4 is the most likely one, but again, liquefying after a crisis has started has a whole series of complications to it. A whole series. And I don't understand why the Fed is not acting right now to
well, that's why I was asking you at the last Fed meeting, why didn't they go a quarter and talk about continuing to ease? If they I still have to think that you have a lot of wisdom and you're a great researcher, but so are they. They see what you're seeing. Yeah. So why didn't they move in December?
Because loosening by lowering rates is something that acts over several years. They've got a problem in a couple of weeks. And I think also there's some politics involved here, is that there's an admission that there's a greater problem in the economy then. Right. Which is what I maintain. I maintain that there is a problem in the economy because they tightened 3 years ago, the money supply. They're saying this is a technical problem in the markets, which is something that's temporary, and we'll deal with it on a temporary basis.
So, I mean, it's always a chicken and the egg. Sometimes it's something systemic that affects the economy.
Right.
And sometimes it's a bad economy that creates a systemic problem.
Or
do we have both happening at the same time?
Yeah, absolutely.
That's a difference. So, sometimes really the housing, the Great Recession was really a financial crisis that spilled into the economy, right? You're saying that the economy
yeah, I mean, if you look back, I mean, housing did let go, but the money supply was cut 3 years prior, and it was dry. It dried out the economy for 3 years.
Same thing was happening.
Right. So it's always there's a proximal cause versus ultimate cause argument, right? And so this will be the proximal cause. This is the tripping crisis, right? And the last time it was Bear Stearns, Lehman Brothers, housing, blah blah blah. That's all they talked about, but they didn't talk about the Fed and the money supply and the tightening. So there are always the proximal and ultimate issues, right? And so I'm looking back 3 years saying, hey, they dried out the economy and it's now dry. And they've done it for 2.5 years before they started to loosen, just like they did the last two times in 01 and 08. So you can see here the repo rates. This is from yesterday. You can see that they jumped up there, about 8-9 basis points. So even with the awareness of what's going on and the reaching into the markets. They're not able to we'll see going forward, but I would expect this to go much, much higher because there is a liquidity problem. And remember, this is not just your primary dealers in this market. This is pension funds, exchange traded funds, the large brokerages. They're all able to reach into this market if they have assets to access liquidity.
We have an interesting question from an attendee from Giarzhola. If Canadian banks are an option to finance the repo market, is that part of the reason for the sudden selling off of Canadian bank assets? For example, they are selling their operations across the Caribbean urgently?
I think it maybe goes back to the very first thing that I talked about here earlier, is that Canada has a severe credit bubble problem, which appears now to me to be even more advanced than the U.S. in terms of like we're running on the spot right now. And I just think in general that there's severe problems, and that the U.S. issues with the U.S. economy impacts us doubly. We've got the tar sands, the turndown in the energy sector, the scramble for capital on every front, and I think that the banks can see the level of distress out there.
Right. Okay. Yeah. We were talking about that yesterday with Adam Button about, a lot of paper for the frackers from 5-10 years ago is due, and they have to roll, and there's no one willing because of the quality of the crude, not just the quantity. So it's not just the oil patch in Canada this time. It's Canada.
I don't think you can head into a year end saying, well, maybe the Canadian, but that's what's kind of ironic about Zoltan Pozar's most recent paper there, is that he says like your options are Canadian banks of all things, or the Fed stepping in with QE with direct liquidity injections.
Wow, it's really, I'll tell you what, I think I'll stay sober New Year's Eve to watch everything that's it's interesting. We're only a week or so away to see how all this goes down, and really not that much talk about it out there. I hear a little chatter about it.
Zero. I mean, there's Zoltan Pozar and the odd article of his and the odd recognition of it. But what I find interesting, he says this is the first time that we've entered into the turn with insufficient reserves.
First time.
First time.
So that means it's been a long time, like never before.
Yeah. So we're about very, very soon about to see how this all plays out. So the most likely scenario I think is QE4, and what QE4 means is a wall of money coming at us. Right. We've had this worsening situation in the markets, and what I found, there was a paper. This is a summary here of commodities which give a leading indicator of inflation. And inflation, I'm using the classic definition of inflation, which is an increase in the money stock, the increase of the money out, which is followed after a lag by, well, first of all, you have juiced capital markets and juiced financial markets, and then ultimately the prices of things rise. But what this study found was that platinum was the first one to move. It had a lead time of about 16 months over a rise in inflation. And that was followed by silver, and then followed by gold with a 12-month lead. The CRB index raw materials are pretty poor and pretty low coefficient.
Yeah.
Right? And crude oil had a negative correlation, so no correlation there. And this is referring now, the reason I'm moving towards this discussion here is from the point of there's a wall of QE4 coming. So looking about what do the markets see? And so platinum was the lead indicator. And that was the markets, that was the markets from 1972 to 2007. The data, because of course the gold was pinned until 1971.
Right.
So platinum was the primary industrial metal for catalytic converters, but that's switched about 10 years ago to palladium. So here's what palladium has done. This is a 1-year chart here. So you can see here at bottom at about 800, and it's 1986.
Yeah.
Right. So it's gone up $1,100 in the last
Year.
9 months. Yeah, under a
Yeah.
year.
Yeah.
It started to run now. And of course, why would they run? Well, these are such small markets, and all you need is investors at the margins to be stepping into these things that you can't print for them to go much higher very rapidly. So there's palladium, and here's the palladium price going back 5 years. So you can see that it's ramped up materially. So the next one was silver and then gold. Here's an historic look. So this goes right back to 1970. So the orange line is gold.
Yeah.
And you can see platinum has since broken down when they switched over to palladium.
Right.
That's the primary industrial metal now, but you can see that has run really strongly. Gold, of course, moved up and then down.
And there's silver.
And there's, silver still asleep, and platinum is still asleep.
Okay, so basically the theme is don't wait to buy gold and wait, and maybe even a little palladium. And
I think things that you can't print are going to get much higher, go much higher in price. By the way, here, this was the gold withdrawals. These are the...
you tweeted that. Got a lot of reactions here.
Yeah, that's
on Twitter, yeah.
That's people standing for delivery to get gold out of the comics, yeah.
Yeah. What was that guy's debate about it that, I let it go on for a while. Anyway, thanks for, David, thanks for coming in today, unless you have something else, and the content that you tweet.
That we've broken the trend here in standing for delivery. This is the last 3 weeks here. So, I mean,
people want it.
They want things that you can't print going into the year end. Yes.
They want delivery. It wasn't a trade. They just put it on for delivery, which is unusual in itself.
Real David Jensen is my Twitter, and I post the information I have, and you and I are in touch there as well. So keep the conversation going.
If I don't talk to you, David, Merry Christmas, buddy.
And to you, Dale.
And Happy New Year. Let's let's hang out in a hangout room or something. And,
let's hope the world doesn't stop turning.
Yeah. All right, David.
Okay.
Really, and I hope it's a great year for you. And thanks for spreading the word so people at least have some type of hedge for what might be happening here. I appreciate that.
My pleasure, Dale.
Everyone at Real David Jensen, follow him. One of the better minds I've come across, and I've interviewed over 1,000 people looking at things internally. So definitely should be part of your intelligence gathering. And that's a wrap for me, everyone. Remember, don't just count your pips or coins, count your blessings. And we'll be back with you tomorrow as the S&P is starting to fade. Adios. Thank you, David.
Thank you.
You're welcome, everyone.